Hey guys, Whitney here. Welcome to the Multifamily Investor Nation podcast. I'm your host, Whitney Elkins Hutton, Director of Investor Education with PassiveInvesting.com. And with us today, we have Karl Krauskopf. Karl, welcome back to the show.
It is exciting to be here and exciting to see you again. It seems like it was just a couple days ago that we saw each other out in Salt Lake City. So good to see you again here.
Yes, at the best ever conference, and we were holding puppies. Guys, you just have to go to the conferences to really fully understand what it's like to hold puppies at a real estate conference. Anyways, well, we are here today to talk about Brentwood Apartments, 12 units in Seattle, Washington. But before we do that, Karl, tell us a little bit about yourself, your background, and where you are in the multifamily space.
Sure. So I spent 10 years in corporate strategy for a healthcare tech company down in Los Angeles. Really loved it. It was great. Started buying a small multifamily here in Washington State just as an additional income stream. Really fell in love with the process and started flipping homes. Moved quickly into building a scalable home flipping business in the Puget Sound, Seattle area. And in the first 3 years, did about 30 homes. Started building ground up construction infill in Seattle. Townhomes, and quickly moved over into the multifamily long-term hold back in 2021 when inflation data became non-transient and a sticky situation. So here we are in 2024 and still a sticky situation.
Sticky it is, but you closed an apartment building in the midst of this sticky situation. So
Two.
our
Yep.
listeners are so excited to hear from you on that. So let's dive in. Brentwood Apartments, 12 units, Seattle, Washington. Let's back up the timeline. It sounded like you closed this deal in July last year. What was
Yep.
the purchase price?
So bought the apartments for $2.5 million at about $210,000 a door. At the time, apartments that were trading for about $375,000 a door. So we got a pretty significant discount on that purchase.
Excellent, excellent. Okay, so how did you find the deal?
It was on market. It was right there in broad daylight on market, and it was great. I had toured it back in October of 22. Just the price was not right for me at that time. And broker called me back in January of 2023 at this point. Yep, January 2023. Asked, hey, we're bringing the price down. Do you want to come take a look at it again? And sure enough, we got it under contract. And yeah.
So what was the asking price? If you closed at 2.5, what was the asking price?
So it's interesting. So it was originally asking price was four and a quarter. $4.25 million. I went and saw it when it was listed for 3.75. And then went under contract on it for, I believe it was three and a quarter.
Okay. Sounds like there's a story here. So we'll get to that part of the story. But I just wanted to draw out for our listeners is just because you see a deal that's overpriced, it makes sense to keep in touch with the broker about it, keep it on your radar. And the longer it stays on market, that you might be able to scoop it up at a better price. So, Karl, were you competing with anybody else, or was it just you at this point in time, like putting
I
an
think,
offer on the property?
yeah, there was definitely I would say a little bit of competition, right? Again, kind of rewind to the timing. It went on market in Q3 of 2022, right? So we had a bunch of basis point increases at that point. And so buyers were trepidatious. They were not sure what to do. And from a competition standpoint, sure, there was still enough out there. But I would say generally speaking, a lot of people were gun shy at that point.
Awesome. Okay. Well, all right. So you get it under contract. How did you structure the offer to beat out the competition?
So how I structured the offer was short feasibility, a short financing. Still obviously had enough in there to close the deal with a sufficient timeline. But again, went in short feasibility. And the reason being is from a short feasibility standpoint is I had already done a ton of due diligence back when I toured the property in October 2022. So I had already done the financials. I had already done the operating due diligence. So I already had a little leg ahead of the feasibility.
Okay. And so did you just have like a regular 30-day closing, 30 days due diligence, 30 days closing? Did you have any extensions baked in there?
Yeah, good question. So 30-day feasibility, I believe it was 60-day finance contingency, and then a 2-week close post waiver.
Okay. And did you put down any earnest money on this deal?
Yep, put about $62,000.
Okay. And was that hard or contingent?
Contingent following, yeah, it was contingent following the feasibility in the finance waiver.
Okay. All right. So you got the deal accepted at 3.25. Now you go into due diligence. You got 30 days to go through all the due diligence. You already have a little bit of a leg up. What did you uncover here?
Nothing surprising. So how did I get from 3/4 to 2.5?
Yes.
It actually came with development land. So 12 units had a large backyard, essentially parking, that had already been permitted for townhome development. Um, and I think that, effectively took out a decent amount of operators, decent amount of potential competition on the deal, because they didn't necessarily want to overpay for the development land. So essentially what we were able to do and how we negotiated a 2.5 purchase was essentially we carved out that parking lot or the permitted land, allowed the seller to keep it, to retain that because he was a developer. Uh, he was not an apartment operator, and allowed him to keep that, whereas we were buying the asset that we wanted, which was still the apartment complex.
And so to sound that back to you, he actually had everything rolled up in one, was hoping to move the whole thing, but you're sitting here looking at the higher and better use of this is for me to operate, you to stay in your lane as a developer, and you just teased everything out.
Bingo.
Awesome. Okay. So physical due diligence goes pretty well. No surprises here. What
Nope.
about the financial due diligence?
None. It was pretty straightforward. No bad debt, no delinquencies. From a tenant perspective, we had long-term tenants in place, and it went pretty smoothly from a finance standpoint as well. I think the other portion that may have added some additional motivation into the seller to accept that price, essentially, is they were on variable rate debt with an already extended loan.
Okay. So at what point in time did that conversation of carving out the development piece, like what point in the contract negotiation or the sale negotiation did that
Sure.
get carved out?
Yeah, so it was in the feasibility point, and originally what I wanted to do was go out and essentially assign or sell off the permitted land to another developer for a higher price. Went to the builders that I had worked with in the past, and again, this is early 2023, so cost of capital was high. Residential market was a little bit still uncertain, and there was just not a lot of builders buying a product at that point. So still wanted the deal. I still wanted the deal, and went back to the developer and said, hey, how can we make this work?
Oh, okay. I love that. How can we make this work? Very different words than what you sometimes hear. Somebody gets stymied by an obstacle and they say, I can't. You
Yep.
change it and you say, how can I? I love that. Okay, so what's your overarching business plan? I want to get into lending next. We haven't, for listeners, we're going to get to that point, but what is your overarching business plan with this particular property?
Sure. I would say slow burn and churn in terms of tenant turnover. Go in, renovate the interiors. One of the part of the business plan that we added was didn't underwrite it in, but added in from an ideal perspective is to go in and essentially terminate the boiler, terminate the gas as a utility, and switch over to electric heat. So from an operating cost perspective, it's about $10,000 per year. Not a huge number, but going into it was Seattle City Light, the electric provider, actually also offered rebates for particular upgrades if you transitioned from heat to electric. So we're also going in and doing full window replacements, going from single pane wood frame windows to triple pane, all at about 60%, 60 cents on the dollar for the window costs.
Fantastic. And then what is that going to do for the rents on the property?
Yeah, so we've already proven out the rents. We've already proven out the rent projection of about $350 per unit for the renovated units. and it's working great so far. We're about six units complete, halfway through, and right now the tenants are just going to stay in place, and we're increasing rent slowly, to maintain what we expect from a performance standpoint.
And so you're able to do that 300 to 400 rent increase per unit, just to clarify.
Not on the good question. Not on the existing leases, no.
Okay.
On the new leases, yes.
Got it. Okay. I was like, and everybody's taking that? Like that sounds like a bit challenging.
Yep.
But thank you for clarifying there. Let's talk about the debt on this property because, things haven't quite eased up as much as everybody anticipates. We're recording in May 2024. You closed this property in July 2023.
Three.
So yeah, what kind of debt do you have on this property?
Sure. Recourse credit union, local credit union, and we are, let's see, 65% LTV on it. We are on a 5-year fixed rate at 6.34. We had 24 months of interest only payments. And right now we're already exceeding a 1.27 DSCR, debt service coverage ratio. So we are ready to rock and roll in terms of going fully amortized, but we've got another year on interest only. So at this point, we're just raking in the cash. There's some potential plays that we may go forward with in terms of instead of distributing cash flow is actually paying down loan, just so that way we can be in a defensive position in case we get to that point 4 years down the road and rates are still higher than we expected.
Gotcha. Well, and anybody listening to that, if you're listening to Karl and you're going like, we're going to still be in this environment in 4 years. I noticed the words he said, defensive play. So making sure that you're stress testing all models.
Yep.
All right. So were there any lockouts on this particular loan or prepayment penalties like for this?
Yeah, we had a good question. We have a 3-2-1 prepayment penalty.
And it stepped down. Okay.
Yep.
Did you raise capital on this deal?
Yep. I raised $1.1 million on it.
Okay. And so, and then how did you structure this with your general partner? And then, or if you're the only general partner, and how did you structure it with your limited partner?
Yep. So I am the only general partner on it. Raised the capital, operating it myself. And I want to say we're 70-30 in favor of the limited partners.
Okay.
And the traditional waterfall 7% preferred. No hurdles, no IRR hurdles, no cap on a return either.
Okay. All right. So let's talk about how was it taking over this property? Just like, the first 2 months, like, were there any bumps in the road here?
I think that the only bumps in the road that I can recall at this point was the transition of management. If listeners recall or go back to our previous conversation on the other deal that we closed in 2022, we retained legacy management, which was fine, third-party management. The third-party management on this deal, the legacy manager, was just far too costly for a 12-unit apartment, right? They were probably a blended rate of about 11 to 12% between payroll and management fees. So just didn't make sense for us. So we went in and switched over to a low-cost provider, low-cost manager, but we can talk about how that process went.
And did it go over smooth?
Did not go over smooth. Didn't go over smooth. Just the manager, we won't talk about who the manager was, but it just didn't work out well for us. We had to let him go. We had tenants leave, essentially quoting the management being an issue. But that being said, we've taken it in-house, which is something that I, actually enjoy. So I've got a full-time asset manager who's responsible for the property management of it, as well as another 8 units that I own in the city.
Awesome. Okay, well, let's wrap up here a little bit. I got 2 questions for you. What did you find easy during this process that you thought would be more challenging? And then what did you find that was more challenging that honestly you thought was going to be easier?
Yeah. Renovation was the easier than expected. Simply because, again, I born and raised in the home flipping business. Spent the last 6 years flipping homes in Seattle, Washington. So I've got I would say, a sizable Rolodex of subcontractors, general contractors to call on for, I would say, expedient, not only maintenance, but unit turnovers. So that was super helpful. Really allowed me to tap into low cost, high quality contractors, and move in quickly. And then what was more difficult is at this point right now. So the developer didn't break ground until earlier this year. Um, and there was a point where we were expecting them actually not to break ground, just because nothing had happened. They were quiet. It looked like things were lapsing. So, but now the difficult part is managing the existing tenants, their expectations, and how we are not the owners of the development. We're not the benefactors or beneficiaries of the development. Um, and so I can't necessarily cut rent rates because of the development that's happening in our backyard.
Mm. And what is it going to be developed into?
4 luxury high-end townhomes.
Got it. Got it. Well, Karl, thank you so much for sharing your time and expertise with us here today. If listeners want to find out more about you, how can they do so?
Sure. Two places I love is LinkedIn. So find me on LinkedIn. And then secondarily is our website, gold-mf.com.
Excellent. Well, Karl, again, thank you so much for spending your time with us here today. We look forward to hearing about your future deals.
Love it. Thanks so much, Whitney.